Okay,
things
runoff
that
is
runs
exactly
into the
your,
sewage system.
it's your excess water, you know, it rains. And the rain doesn't stick to the building, so it runs down the wall and into the parking lot and into the street. So that water, as it runs through the building, or maybe through the roof, and then through the pipes, and then down to the parking lot, and all of those, it starts picking up these pollutants that are there. That's runoff. The Truth in Lending Act, or Regulation Z, is Title I of the Consumer Credit Protection Act. Most of the requirements imposed by the Truth in Lending Act are contained in the Federal Regulation Z. Therefore, the terms, the Truth in Lending Act and Regulation are often used interchangeably. It informs consumers of exact credit costs under the Federal Trade Commission. Bait and switch advertising is a federal offense. That's why I said it's used more in lending. It's implemented by Regulation C, and it applies to credit regarding residential mortgage loans. One of the things that it does is you are required to, the lender, is required to disclose the annual percentage rate. Does anybody here, or can anybody here, explain to me what the APR is? Annual percentage rate.
Interest plus closing costs.
Interest plus closing cost. Yeah, it's the cost, the actual cost of borrowing. The lender tells you, okay, you apply to the lender because you want to buy this $100,000 home, you file an application, you give them all your financial and credit history, and then they send you back, hello, congratulations, we're going to lend you the money, $100,000 at 5% for 30 years. Then in another paragraph of the letter it tells you, and we're going to charge you 2 points, or 2%, to lend you this money for us to prepare the work, and in addition to that you'll have some other costs. Well, some other costs, for instance, will include not only the points, but they'll charge you for preparing the documents, they'll charge you for reading the credit report, they'll charge you for actually sending the money from one bank to another, they'll charge you for all these things. All of those things are the cost of acquiring the money. And what the federal government said to banks is, when you're going to charge somebody to lend them money, in addition to what you're lending them, then you have to disclose it in two ways. You have to disclose it not only in amount of money that they're going to pay extra, but you also have to tell them in an annual percentage rate. So most loans you'll see, actually every loan that you'll ever see advertised, has two interest rates attached to it. You'll have a note rate or a basic interest rate, let's say 5%, and then your APR, I don't know, 575 or 580 or 605 or 702, whatever it is. The difference is what all those things added to in percentage rate. They have to report that to you because that's profit to them. In essence, I'll say it a little different. If you're borrowing $100,000 from the bank, and you are required to bring a $2,000 check at closing because of all the closing costs, did they actually lend you $100,000? No, they actually lent you $98,000, but you still have to pay them back $100, and your payments are based on $100. So it's called additional profit. They want you to tell you that even though they don't use the word profit. So that's the basic definition of annual percentage rate. They have to do that within 3 days of accepting your loan application. In other words, they have to tell you how much they're going to charge you for lending you the money in addition to the interest rate that they're going to charge you during the loan. They have to include the interest rate and other loan costs. They have to represent a true yearly cost of credit. And they have to give you an updated disclosure required at least 3 days before closing. And any time that their system changes or they charge you for more, or they're updating their system, towards your loan, and the APR changes, they have to tell you. So sometimes you get 2 or 3 disclosures during your term of between the time that you actually apply for the loan and closing, because every time it changes, they got to tell you. So they have to do that again. They have to do an updated disclosure within 3 days after they accept the application, and at least one more time 3 days prior to closing. So there are no surprises, or at least they try not to have any surprises. Now, what they call triggering terms. The Truth in Lending Act and Regulation C also said that they were concerned about consumers not knowing the difference. So they basically said, if you in your advertising are going to use certain terms, you have to say something else. You have to give them additional information. So some of the triggering terms that they use, for instance, is the amount of, if in the advertising they tell you the amount of the down payment required, $1,000 moves you in, for instance. Then they also have to tell you how many payments, and they have to tell you the period of repayment, and they have to tell you the amount of the payment, the amount of finance charge. So when they use any of the triggering payments, the triggering terms, they also have to tell you the amount of the percentage of down payment, the terms of repayment, and the annual percentage rate. They have to do this. So if you read the next time you look at a newspaper and you look at the banks willing to lend you money, and you see that they tell you the amount of down payment or even the interest rate, then they'll have the APR in parentheses, and they also have to tell you for how long, 30 years, and they'll have to tell you how much of a down payment. They have to tell you. Once they trigger by one of the terms, they have to give you the additional information. So if you look on page 155, triggering terms are amount or percentage of any down payment, the number of payments, the period of repayment, amount of any payment, and amount of any finance charge. If they tell you that, then they have to additionally tell you the amount or percentage of down payment, the terms of repayment, and the APR. The three-way right of rescission. The borrower has the right to rescind or cancel the loan contract upon midnight of the 3rd business day following the signing of the loan documents. The right of rescission can be waived by the borrower for financial reasons. The right of rescission applies to most consumer loans but does not apply to loans for purchase or construct a home. If refinancing with a new lender, the right of rescission applies. If we're refinancing with the same lender, only the additional money added to the original loan may be rescinded. The 3 business day right of rescission applies to home equity lines of credit, second mortgages, and refinance loans. So remember, and don't get it confused, the original loan, when you purchase your property, the minute you sign on the bottom dotted line, there is no rescission. You bought it. You have no rescission. You have no right to cancel. Once you get out of the closing, you own the place. However, once you own it, if you're going to refinance, then they're going to give you 3 days. I call it consult with your pillow. You go home after you sign the documents and you get to think about it for 3 days. Did I do the right thing? And you have the right to cancel, even though everybody worked. And nobody's going to get paid because you have no penalties whatsoever. Now, the reason why they give you the 3-day rescission also is because they didn't give you the money yet. You don't have the right to consult with your pillow, because if they gave you the money. If they didn't give you the money, they're going to wait until the 4th day, make sure that you didn't change your mind. So on the 4th day, they're going to give you your money if you refinanced. Everybody understand that? Now, a borrower who wants the money immediately because they need to spend it tomorrow, they can, if they want to, in writing, they can waive the right of rescission. If they waive it, obviously, then they don't get to consult with their pillow. It does not apply to loans for purchase or construct a home. And it applies to home equity lines of credit, second mortgages, and refinance loans. The Equal Credit Opportunity Act. You know what? Let's stop right here. Let's take a break. Because we're not going to be here very much longer after that anyway, but I don't want to let you go right now. You need a break. So it's 2:45. Let's take a 15-minute break, come back at 3 so that we can be here for a little while. Turn that machine off, please. For now. Okay, the Equal Credit Opportunity Act. Essentially what it says is that lenders are required to make credit available without discrimination based on race, color, religion, national origin, sex, marital status, and here comes the other two, age and receipt of public assistance. So just because, let's use me as an example. I'm 62 years old. Can I go to a bank and ask for a 30-year loan?
Yes.
Of course I can. They're not supposed to base my approval because I'm 62, therefore I may not live to be 92. So they can't do that. Also, the last one is receipt of public assistance. If you receive public assistance, whether it's unemployment compensation or you're just on Social Security or you retired because you were hurt and you receive public assistance. Public assistance is wages. They are not allowed to turn you down because the wages that you make come from a governmental agency. So it's money. They're required to use the numbers that enter your household as far as income is concerned in order to qualify. Anybody knows what RESPA stands for?
Real estate standard practice.
No, no standard. Real Estate Settlement and Procedures Act. What did I say RESPA covers?
Kickbacks.
No, in addition to kickbacks. Every residential transaction that is accompanied with institutional financing or as they call it, federally funded transaction. In other words, it's a sale, and with the sale comes a loan from a bank that belongs to the federal government, or it gets their money from the Fed. So if there's a loan together with the purchase, and it's by definition what is residential, 4 units or less. So if it's single family, duplex, triplex, fourplex, and the sale is accompanied by a loan, RESPA applies. Whereas RESPA says? RESPA says that consumers should know the amount of and type of charges that they're going to be charged at closing. It attempts to eliminate kickbacks and referral fees, and it applies to federally related residential loans or loans secured with a mortgage on a 1 to 4 family dwelling. What are exempt transactions? Well, is 25 acres, parcel 1 to 4 family dwelling. No. Okay, so if you're going to finance the purchase of a 25-acre lot, is that a RESPA transaction? No. Is a home improvement loan or refinance loan a RESPA transaction? No. You're not purchasing, Loan to finance the purchase of a vacant lot. Is the dwelling